Forex Focus brought to you by IG. So happy to have Paul on with us. As Paul, we've quickly gone from talking about interest rate hikes with the Fed through, the last couple of years, and even up until September, October range, a significant chance of another hike priced into futures markets that measure the likelihood of where the Fed funds rate will be, which is, of course, the interest rate that the Federal Reserve controls. And now we've turned so quickly away from hikes to, all right, no more hikes being priced in, and we'll get to the odds in just a second, to now potentially cuts. And it seems like I say, hikes are over, and now everyone is just asking the question of when and how much around these cuts. From everything you've seen, does it sound like the hike train is over here in the U.S.? Because, you who have such great knowledge of stuff going on throughout the Forex space, central banks in Europe, central banks in Asia, and Australia, they've called it quits already, and the U.S. has not, but the market is kind of priced it in for them.
Yeah, that's what the market did kind of pretty aggressively yesterday, especially in equities. The dollar obviously got killed yesterday. It was when you start getting into the 2% moves in single currency pairs, there's something big is going on. 1% can happen, and it's not necessarily normal, but when it's outside of that 1%, it's when you realize there's some sort of shift there. So the market totally priced out any sort of rate cuts this year. We'd have to see basically inflation really tick back up for even the Fed to consider anything at the December meeting. Even that one inflation print might not be enough for them to kind of change their mind. Would change the path of kind of rate cuts for the 2024, which I believe we're going to talk about in the future. But the thing with rate cuts, and I think people forget about this, is why the Fed actually would cut rates. And it's the cut rates is to ease monetary policy, to make monetary policy more loose, basically spur the economy is what the theory behind it does. So they would only really do that if the economy wasn't doing as well. So you have to keep that in the back of your mind. But yeah, it's definitely something interesting. The Fed funds futures probably changes every day at this point, depending on the day. But it'll be super interesting in the new year to kind of look forward to. Not to say we couldn't have a very interesting December.
Yeah, and great point that, of course, these odds shift around. They shift around as fast as futures markets do because they're taken from the futures markets on these interest rates. And so you've seen this shift the last couple of days more and more towards cuts and away from any, like you say, any potential hike here throughout the rest of the year has pretty much been priced out. We went from, having you on the show a couple of months ago and the odds being 50-50 of one more hike to slowly drifting lower to, 30% chance of one more hike, 20% chance. And then as of yesterday, which to be clear is the day when inflation ticked lower, that's when they really took out any chance of it in that futures market and started to price in cuts. Now, that's all to say it can get built in very quickly once again. These markets shift around very, very quickly. But right now, looking at a 69% chance of rates cut by 100 basis points or more in 2024. The Fed funds futures priced here from the CME group, you can see, Paul, the distribution is focused around that 425 to 550 interest rate, which would be 100 basis points lower than where we are currently. But you're seeing, 24.9% chance of 125 basis points worth of cut. A small outside chance, about 10% of 150 basis points worth of cut. And we've seen over the course of the last couple of years, especially because when interest rates are zero, and there's a chance of, will they hike 25 basis points off of zero? Not a lot to talk about. The last couple of years, there's been nonstop, hiking, and then will they hike here? Will they stop here? They ended up keep hiking. And one market is wrong always. It's either they've mispriced it here in the futures, or the Fed was saying something that they didn't end up actually doing. And so it'll be really interesting to see how this plays out, because to your point, to cut 100 basis points over the course of the next year here, you would almost expect to see some downside in the economy, not only to inflation at a normal level of 2%, but lower, because we haven't seen, at least in the last 20, 30 years, interest rate cuts without an economic downturn.
Yeah, exactly. I mean, if you think about some of the last few times they cut rates, they really cut them back all the way to zero. I mean, obviously, there was many of those times there was circumstances that warranted going to zero. But yeah, one of them was COVID, obviously. So that was the big move to zero. But yeah, you have to see some sort of slowing in the economy to get them to cut rates, really. You might have to see the job market turn, which is, again, it's kind of overlooked right now on these weeks where we're really focused on inflation. We see inflation's coming down, and equities they turned around and rallied. I mean, we're almost at yearly highs, I think, now at this point. So basically, if you forget about the job market, it can come back really quickly if that turns around. That's where I'm gonna, again, I've been talking about this probably for a couple months now, that you need to keep an eye on it. Mm-hmm. Anecdotally, I could see some fear there, but it hasn't came through in the data, but a lot of that job data is very lagging, so it's something to keep an eye on. Yeah. Especially your first couple months of non-farms is really going to be interesting.
Yeah, great point. That employment piece, not only do they watch inflation, and obviously it's been down ticking, so less of a reason for hikes, but if inflation continues to just kind of hover around 2, 3, 4%, and that inflation really downticks, then maybe we do start to see some cuts here, because the earliest cut that's currently priced into the market, or essentially the first meeting that I looked at through the CME Group's FedWatch tool and saw a 50% chance or more of a cut from where we currently are, is in the May meeting. And so the market right now pricing in that they'll hold unchanged for the next few months here, and would potentially start to cut in a slow fashion in spring, summertime of next year. And of course, the only way that both the market and the Fed end up being right on the same page is if inflation does get down to that 2% target, employment, maybe some other metrics around the economy look shaky, but not necessarily like a full-on recession or downturn. We're not reporting, negative GDP multiple quarters in a row or anything like that, but just look shaky. And the Fed says, okay, we're up here at 5% interest rates. The inflation rate is now down to 2%. The real interest rate is a whopping 3% at those numbers. We can normalize this interest rate slowly down closer to 4%, where the market is projected. And you would expect that if, we do cut 100 basis points in the next year, and they start cutting in the next 6 months or so, as it's currently projected, that correlating yields across the U.S. Treasury curve, because remember, the Fed doesn't control U.S. Treasury yields. They'll move wherever they want. I mean, for example, you have the 2-year, 10-year, and 30-year right here, Paul, all trading under 5%, and the Fed funds rate is 5.25% to 5.5%. So they don't have to all be fully in line, but you would expect that these correlated rates, as well as mortgage rates, car loan pricing, and everything else, would potentially fall with that Fed funds rate.
Yeah, exactly. I mean, a lot of those, especially mortgage rates, are really based off of typically the 30-year. It's a 20 to 30-year plus a premium, just due to the risk of a mortgage as opposed to a U.S. government bond. It's kind of how that's priced in the mortgage market. But yeah, that definitely could be kind of a spur to some real estate. Obviously, we've seen real estate stocks kind of really ramp back up after seeing some recent lows. But yeah, I mean, if U.S. interest rates come down, that means basically mortgage rates comes down, makes a house more affordable on a monthly basis, which is kind of how you think about that. Now, again, this is to my earlier point about the job market. This is where you have to pay attention, because when you think about demand for housing, people have to necessarily be employed to be able to buy a house. So that's always the double-edged side of it. it's the supply-demand dynamic kind of in any market. So again, it's not just necessarily a binary event. If inflation goes down, that will bring down interest rates. That means housing is going to do better.
Yeah, it's a very nimble dance that the economy has to do for all these things to work out. But that being said, the market is currently priced, as you and I both know, the market gets more technologically advanced every single year. There's even more transparency. There's more people in the market. That gets more efficient with greater volume and greater access and everything else. And the market sees all of these things that we're talking about and currently thinks there's a good chance of that soft landing where data falls, economic data falls here in the U.S., but it doesn't crash. Because, to your point, lower mortgage rates and all these different things can spur, as you can see here, XLRE, the real estate sector, that's gotten absolutely annihilated over the course of the last 2 years of trading, especially when you compare it to, an energy sector and a technology sector that are positive over this time frame. And those lower mortgage rates can spur that real estate economy once again. But if this data crashes and mortgage rates crash along with employment and these other things, well, that's going to bring everything lower. So right now, if this all goes according to plan and according to these projections from the futures prices and everything else, that rates just normalize down to 4% or 3% without employment turning negative on a monthly basis and inflation turning to deflation. And like I say, GDP reporting negative like it has in parts of Asia, parts of Europe, then all could be good here. Another effect that I want to get your take on with this recent lowering of interest rates here in the U.S., worst day of the year for U.S. dollar yesterday, in line with some of the best inflation numbers that we've seen in the U.S., but obviously some of the great lowering of interest rate expectations around that lower inflation. And we're talking specifically for the pound and the euro, 200 pips higher in the pound, 150 pips higher in the euro. Aussie had a great day against the dollar as well. Some huge movement here for the dollar to the downside.
Yeah. I mean, again, the market really just priced in. And there's no chance of further hikes really this year. That's what the spot market was really pricing in, that short end of your interest rate curve, and it did it very quickly. Right bang on the number on the CPI print. I was looking at some charts yesterday. You had anywhere from 50 to 100 point moves in a single minute. Again, not something we've seen as much this year. Last year wasn't necessarily out of the ordinary because CPI days, if it came in hot, that dollar was off to the races, rallying. This was on the flip side of that. So it can happen quickly, and it did happen quickly yesterday, and it didn't seem to stop. The market didn't give it back. Sometimes you'll see a kind of an overreaction to a poor number, and then the market kind of gives some of it back, but it didn't really do that yesterday. We have to believe it closed towards the highs, and especially pound dollar and euro dollar.
Yeah, it lets you know that there could be room for more of these type moves, because we've seen a lot. More often than not, we see the 100 pip, 120 pip move, and then it pairs half of those gains or losses throughout the day. Closed right, built throughout the day. It was off of the number. It was only 100, 150 pips in the pound, as an example here. Closed the day 200 pips higher against the dollar. But this leads to the question I want to get out of here on this, get your take, because this can go a number of ways, which is, first of all, the caveat has to be inflation can build right back in just as quickly as it came out, and this U.S. dollar can build right back in just as quickly as it's come out the last couple of days. But if this does continue in this trend of inflation normalization in the U.S., interest rate normalization in the U.S., U.S. dollar giving back some of its historic gains that it's seen, parity against the euro last year, 150 plus against the yen last year and recently, 105 against the pound. Who stands to make the most? Because you look at this yen chart here and you'd say, oh, well, if dollar goes from 0% to 5% back down to 3%, then the weaker yen could gain the most here. But also, there's a case to be made for the strongest, which has been, your pound, your Swiss franc, some of those European currencies, that if the worm turns on dollar, but UK data stays strong, that pound could take back a bunch of ground, because obviously all of these currencies against the dollar at historical lows.
Yeah, I mean, you think about getting back to more historical norms for pound and euro. I think you could see as more likely. Doesn't mean data can't flip on their side, and things always. I mean, with all these things, it's depending on the data in the next couple months, in the next year. Obviously, things change kind of quickly throughout the economy. I'd say the yen's probably the least likely to gain from all this. And unfortunately, if you saw the GDP number that came out of Japan last night, it was pretty much downright awful. Yeah. It was pretty bad. It was basically month-over-month GDP, or it was quarter, but came in well below estimates, which Japan's economy had started to pick up steam towards the summer, and it looks like it had lost some ground there. So it's going to be tough to see the yen kind of gain back some of its ground. Obviously, a real tough economic dynamic there. It's been going on. We're into over 30 years of kind of a slower economy in Japan. So it's definitely an interesting one, but definitely going to be a harder one for it to give back. And it doesn't seem to want to give back the 150 level on dollar yen right now.
Yeah, that's a great point, I think, to leave off on is, the current economic landscape, all else equal, if the U.S. gives back some of its economic strength that it's seen over the course of the last 2 years, then you would expect the pound and the euro and some of these currencies, all else equal, to be the biggest gainers, given that their economic data is still much stronger than it is in Japan or in China or Australia. And so, that's a good point to make there, is that Japan and U.S. has the biggest gap to close. But if Japan is still seeing worse and worse data along with, the U.S. or the way the global economy is trending, yen doesn't have to pick up some steam, whereas UK data, Eurozone, parts of Europe have still been relatively strong. Last piece, just to get on here to give you all parts of the economy. Gold, also a market that could gain on lower interest rates. You'll remember that, especially looking at the end of 2022 portion of this chart, when gold got down below $1,700 at the height of inflation and how higher interest rates going to go, obviously negatively correlated to the gold market. And the non-interest bearing gold could see some more demand if interest rates themselves fall. But that'll do it for today's segment. Paul, thanks as always for coming on. Some great insight around all these forex markets and what we could see from the dollar and stocks and everything in line with a lower interest rate market.